How should you invest in 2023 to stay ahead of all this uncertainty? GST going 8% and interest rates at all-time high. I don't know about you, but personally, I have 4 investing mantras or principles that I follow and wish to share with you in this video. Before we begin, do subscribe to our channel and hit the like button. In return, I'll share with you a financial meme. Alright, so I hope that whatever happens in the meme doesn't happen to you. Okay, with that, let's go to our first investing mantra, investing based on each of our own unique circumstances. Have you ever heard of the idiom 知己知彼,百战百胜? Okay, translated to English, it means know yourself, know your enemy, 100 battles, 100 won. Okay, when it comes to investing, many investors don't know what type of investments are suitable for themselves. So they simply just charge towards the enemy, such as cryptocurrencies and high growth, sexy stocks, because they hear of people bragging about their stories, how they make 10 times return of a particular stock or whatsoever. Ultimately, you get lost in the big ocean full of the big whales and the ferocious sharks because you don't even know what hit you. And if there's one key takeaway for this video, alright, it is to find out about your risk tolerance, okay, and invest based on that. For example, if you are 60 years old and near to retirement, it doesn't make sense for you to invest the way youngsters do because they have a much longer runway than you. Imagine a youngster investing in all those high growth stocks. They can afford to wait until the crash is over in the next 5 to 10 years. But if you are near to retirement, what you need is perhaps passive income, right? And the monthly cash flow that's coming in. So instead, you should invest in dividend paying stocks as well as REITs. All right. But hold on, I know what you're going to say. Wow, but all the REITs are going down because of high interest rates, what? So it doesn't make sense. Okay, so this brings us to point number second. Alright, the second investing mantra that I have is to stick to your plan. Okay, if you fail to plan, you plan to fail. Alright, when markets turn choppy, even experienced investors can become too focused on short-term market movements. This can lead to hasty decisions, such as trying to time the markets, or for instance, people buying into US tech stocks at all-time highs. Therefore, it's crucial to have a well-structured plan, right? Once you have it in place, so that you can stay committed to that. Right? Take for example myself, I'm still putting money into the robo-advisors each month, okay, using dollar cost average strategy for me, my wife, and my kids. So be it whether the market go up or down, we just put money into this robo-advisor, and over the long term, we are sure that there will be a huge pool waiting for us. Okay, and history has proven that, right, stock markets have gone up in the past against all odds. Be it like the global financial crisis, the tech boom bust, alright, and the euro credit crunch and more. Alright, and if you think about it, you can even take advantage of undervalued quality stocks you like, such as Starbucks, McDonald's, Microsoft, and more. As Warren Buffett once said, you should be fearful when others are greedy, and greedy when others are fearful. So given that everyone is fearful of high interest rates right now, during an impending recession, isn't it a good time to be greedy? Right? Essentially, the stock market is a device for transferring money from the impatient to the patient investors. Okay, so it comes to our third mantra. After finding out your own risk profile and a plan, okay, the third principle that I'm going to share with you is to build your own portfolio. Okay, the majority of us should always diversify our portfolio because the advice of concentrating your bets into one basket and watching it carefully like a hawk It's really meant for people who want to go big or go home. Okay, so just take the recent shares stocks or the crypto boom and crash for example. Many YOLO investors think that these trends, are the future big trends until reality or interest rates hit them hard. It's common to hear that stocks have went down by more than 70%, 99% and more. Okay, so it's very common, that everyone is facing a double-digit loss right now. On the other hand, all right, if you have taken the advantage of the oil price boom, like Warren Buffett did, and invested in oil and gas companies like Occidental Petroleum and Chevron, all right, you will be sitting with more than 50 to 100% gains in year 2022, like what Warren Buffett did here. Okay, and you don't even have to invest in stocks when valuations are frothy. So those who are risk averse and they say, I don't want to invest, the risk is very high right now. All these stocks are going up like there's no tomorrow. So they want to keep a lot of cash as dry powder. Right now they are the ones grinning from year to year as they plow them inside the fixed deposits or the government bonds that pay a good 3 to 4%, almost risk-free return right now. Hence, having a good asset allocation allows you to better position yourself, spread out the risk, and tap into opportunities when they come. And more importantly, all right, they can give you the peace of mind, allow you to sleep comfortably, at night, knowing that your portfolio will withstand the test of time. All right, the last principle that I have is a unique one, as I'm going to share with you the story of Peter Lynch, one of the most successful and well-known investors of all time. So during Peter Lynch's tenure at Fidelity, okay, between 1977 to 1990, right, he produced an annual return of 29% by growing the assets of the Magellan Fund from 18 million to 14 billion. If you were to look at this picture over here, so imagine you grow, you started to invest $1. By the end of 1990, okay, your $1 would have become $28 versus only $6.60 that of the S&P 500. So that is, I think, more than a 4 times return compared to the S&P 500 returns. Okay, when asked about how he pulled off this remarkable feat, Peter Lynch's advice is to invest in companies you know. All right. So in his words, never invest in an idea you can't illustrate with a crayon. Simply put, invest in simple companies that you understand. All right. Okay, but before you rush off to buy shares in a company that you know and buying making your favorite products, you need to know that Peter Lynch is referring more towards staying within your circle of competence and not like investing in companies that you think you know, for example, the high growth companies, right? But instead, you should invest in companies that you understand well. Okay, one of the companies I know well is Zoom Video. Okay, I use it almost on a daily basis to liaise with third parties for my work, and even my kids, school teachers. When it comes to parents teachers conference, they do it via Zoom nowadays because of the convenience it can bring to us. We don't need to specially go down to the school to just meet for maybe a 10-minute talk. We can just do it via the Zoom, and it can save so much time for everyone. Okay, and for my wife, you can say that she's addicted to Instagram, always showing me how the other influencers are living the high life, going travel to some exotic countries, eating some fine dining food and all that. All right, so yeah, okay, IG is part of Meta platforms, aka Facebook. And you may say that it's a controversial stock right now because Mark Zuckerberg is spending billions of dollars into the metaverse with very limited impact. Hence, although it's important, to know the company that you want to invest in, it merely serves as a good starting point, and investors will still need to do more research into the business, like competitive positioning, the growth prospects, financials, management team, and more. All right. To sum it up, all right, how I would invest in 2023 is to go for the big four investing principles. Firstly, focusing on my own investing style and circle of competence. Secondly, to continue on my own dollar cost averaging into robo-advisors, ETFs, and also to buy the stocks on sale now that everyone is fearful of a recession, right? Third, on the asset allocation part, right? Right now I'm 60-40 in stocks and cash. Okay, so I have 40% of my portfolio in cash. So I intend to increase it gradually to 90% in stocks and 10% in cash. As an emergency tap on the opportunities kind of fund in the next 1 to 2 years. And finally, I will go for quality stocks, all right, that I'm familiar with. One of it can be Zoom Video, Booking.com, Airbnb, Microsoft, etc. Okay, so what about you? What is your investing style and companies you are familiar with? Okay, just leave a comment below and let us know. Anyway, we have come to the end of this video and we hope that you have enjoyed it. If you want more tips and advice how to invest for the better, be sure to like my video and subscribe to my channel. Next up, if you want to check out 5 undervalued tech stocks, make sure you watch this video over here. Alright, so I will see you next time. Bye.